Assalamu alaikum. Welcome to lecture 2 of APM. So my first lecture I've covered and you can watch that under my APM playlist. Now this is lecture 2. So in lecture 1 I've introduced you to the background of performance management, strategic performance management. Now this lecture will focus on the risks and the uncertainty. Now, how do we deal with risk? So forecasting, the role in strategic planning, application of risk and uncertainty at tactical and operational level, decision making under the risk appetite, decision rules, and decision tree. So we are going to cover this and then we are going to summarize the lecture and which part of the syllabus did we cover from this lecture and what technical articles you have to read for this lecture. Now, so the main objective of this lecture is to evaluate your risks and uncertainty in a long-term strategic planning. How do you do long-term strategic planning? I've covered in my previous lecture. This will focus on the risks. See, when you make a long-term strategic planning, of course, there are risks and uncertainty attached to it. That risk we are going to quantify here. Okay. And how do we make decision under the risk? So, much of this lecture is a revision of your performance management. Okay. Remember, the topic covered in performance management can also be asked in APM. But the questions in APM are more like discussion of how risks and uncertainty plays a role in planning, decision making and reporting of your performance. So first is forecasting. Strategic planning and long-term decision making, they rely on forecast. Okay. So when you want to launch a new product, you will not have all the information. Many of the information is based on your forecast. Okay, so you're relying on your sale forecast or your cash forecast for the product that is often backed by your market research. Now, by very nature, forecasts are all estimates. Okay, it might be that your estimates might turn true or not. Very high chances it might not. Most of the time, it doesn't turn what you estimate it to be. It could be worse than that, or it could be better than that, or same as it is. Because you can't make the estimates with certainty. Therefore, management has to deal with this risk. There is always a risk. Okay, risk and uncertainty are two different things. A risk means you know that there is going to be a risk. Okay, so there are several possible outcomes that could occur. Okay, and there is a probability attached to it. For example, when you're throwing a coin, there is a chance it might land up to head or tail. If you want it to land up to tail, there is always a risk it might land up to head. That's a risk because there's a probability of this occurring, this or that. So a gambler who is playing card, they know the potential outcomes and also their related probabilities. It's a risk. Uncertainty, on the other hand, we don't know the probabilities, we don't know the outcomes. They are not known. Okay. Now, activity one, factors affecting risks. So you have to identify the internal, external factor that may affect your net present value or not. Okay. So it's about a big mart who is a global supermarket company and they have changed from a planned economy to mixed economy. So now they want to open a chain of supermarket and they have the decision whether to invest or not is based on a focused net present value over 10 years. So now you have to identify the external factors that could affect your net present value forecast. So let us do that. Number one, cost of capital. If you are my APM students, advanced financial management students or financial management, if you have done, you must be knowing that net present value is based on certain variables. Number one, your net present value is based on cost of capital because to discount your cash flow, you need your cost of capital. So that cost of capital is also an estimate. Okay, that also depends on your market risks and rate of interest. So that's a risk. Next, growth. We are assuming, see, we want to invest in a country. So we have to look at the disposable income of the population of that country. It can grow, it cannot. If it grows, it's good. If it doesn't grow, it's not advisable to invest. Third, customer taste. Customer taste can change. Political changes because it's another country. And taxes and also the wages, increase in wages. So this external factors can affect your net present value investment. Okay. Next, role in the strategic planning. What is the role? See, when you incorporate risks and uncertainty, you have to incorporate. Without taking risk and uncertainty into factor, you can't do strategic planning. Okay, you have to identify the most significant variable and modeling outcomes using simulation techniques when you're doing strategic planning. You have to use risk adjusted discount rates and perform sensitivity analysis in your investment appraisal decision. Sensitivity analysis means if you change one variable, how sensitive the outcome is. Next, we do scenario planning to see the alternative views of what could happen, okay, and what would be the impact. And decision rules, depending on the management's attitude towards the risk. Some they might want to take the risk, some they do not want to take the risk, some are less risk neutral. There are three positions of risk appetite, okay, which we are going to cover in the section 2. Now, exhibit 1, shell scenario. Let us look through the shell. So shell, they have a vision, okay, since 1970. So they want to help the generation to make better decisions. So shell scenarios, okay, they ask what if questions. So this encourages leaders to take remote possibilities into account also. Okay. So this scenarios not only helps Shell, it helps their government, it helps the business to understand the uncertainties that lies ahead. Okay. Now we are going to go through the 3 levels and see their risks and example of the risk. First, at tactical level, planning. Okay. So for planning, we have to consider the risk. That is, risk is considered in the planning process for the medium term. Tactical is at the medium level, right? That's why medium term. So you have to see the risk in the medium process for the medium term. Example, if you're a budget holder, you want to see the possible changes in the economic environment and how they can affect the demand when you want to plan for the allocation of resources. Next, production manager. They have to see the likelihood of the demand. Based on that, then they can plan their production and source supplies. And also the accounting for the potential reliability of supply chain and changes in demand. At tactical level, decision making. So risk will be considered when you're making functional decisions such as purchasing or deploying resources. Example, resources will be allocated to developing and launching a new retail wing. This is at tactical level, right? You have to see the scenario. You want the demand scenario before you allocate resources and what are the market conditions and trends. 2. Second example could be when you deploy mineral or oil extension rigs. You need to consider the favorableness of weather. Weather has to be favorable and also the fluctuations in the commodity price. If it's too much fluctuating, it's not good to invest. Next, in terms of reporting. So when you're reporting, you have to compare your operational performance in the consideration of the possible scenarios and how they can manage the risks. Example, managers report on how resources are allocated in the medium term against the expected values of return given the possibility of specific market scenario. Okay. Now, operational level planning. Here we consider risk every day for day-to-day planning. Okay. So supervisors have to adapt to meet their daily goals. Example, supervisors are in charge of their staff planner. Okay. This they must plan. They have to plan in advance that some staff will be absent, how to utilize the staff which are present. Next, production manager, they have to see the likelihood of supplies. Okay, there could be a chance that supplies might be arriving late or your machine might stop working. It will affect the production manager at the operational level. Next, when the standards are set for sales, production or other functions, you have to account for the factor that it could lead to adverse variances. Next, decision making and operational. You have to consider risk when you're making functional decisions such as purchasing or deploying resources. Now, retail managers, they may need to deploy additional resources after considering the likelihood of larger crowds. Then mineral or oil extraction operators, they have to consider how favorable the weather is when they have to deploy assets in the field. And in the reporting level, managers have to compare their operational performance regarding the possible scenarios. Example, production managers has to report on the output for the period. compare this with the standard output, and also how much manufacturing environment varies. You have to see supply, availability of weather, labor. Okay. Now, risk appetite, very important. So risk appetite is the amount and the type of risk you are willing to take. If the risk appetite is known, we'll know what decision to take based on the risk appetite. So remember, managers are the ones who take the decisions ultimately. So you have to see their risk appetite. Okay, so the choices that they make reflects their risk appetite. But in the ideal world, the risk appetite of managers should reflect the risk appetite of the key stakeholders, sorry. So you have to align the risk appetite of the stakeholders with the managers. This is an essential objective in your performance management and also discussed later in lecture 14 under reward scheme. Decision maker you can categorize based on their risk appetite in the following three categories. First, they could be risk seeker, they could be risk neutral, they could be risk averse. Risk seeker means you are prepared to accept a high amount of risk for a higher return. Mostly gamblers fall in this category. Risk neutral, you are indifferent to risk. You select the option which gives you the highest expected return. So you're neither adverse, nor you seek. Okay. Risk averse are the ones who avoid risk. They want to accept a lower return for lower risk. Now, decision rules. Based on this, we are going to go through the three decision rules. First one is known as maxi max. You need to remember these words. These are common from your PM, so there's nothing new. It's known as maxi max. Both are max max. This means you are choosing an option with the highest return under the best case scenario. This is the optimist rule. They always see the optimist side. Okay, this is the risk seeker's position. If you're a risk seeker, if your appetite is risk seeker, you will go for maxi max. Your decision will be maxi max because you want to take higher risk for higher return. So advantages of this is you are going to get the highest payoff in the best, if the best case scenario does occur, but you don't have to estimate the probabilities of the different scenarios occurring because you have already estimated the best. Disadvantages are, yes, potential would be high, but the probability of it occurring is very low. And all the bad outcomes are ignored, which is not the truth. Okay, in real world, you can't ignore all the bad outcomes. Next rule, maxi min. That was maxi max. This is maxi min. So this is for the risk averse, the pessimist, the one who always see the downfall. They select the option with the highest return, but in the worst case scenario. Advantages: minimum level of return is guaranteed. Your downside is limited. That means below this limit, you can't fall down. Next, you don't have to assign probabilities to the scenario. Disadvantages: you are very negative, very pessimistic. Your returns could be higher than that also, right? So when you choose a strategy, you are likely to get a very low return because you're very pessimistic. Next, it ignores the possibilities of other various outcomes. You are very excessively cautious, okay, when the probability of the worst case scenario in fact is very low. It might not happen. And there is no upside potential to the maximum strategy. That's a disadvantage. It limits your downside, but no limit to upside. Third, mini-max regret. The precision rule is based on an opportunity loss. So it minimizes the regret for having made a wrong choice. So this is useful for the risk neutral decision maker. The one who is risk appetite is risk neutral, mini max regret is for them. So we want to minimize, we want to have as the lowest opportunity loss as possible. Now, for this decision, we require a table of regrets, that is table of opportunity cost, like this. Step 1, for each scenario, you have to establish which decision has the highest payoff and what that payoff is. Then you have to calculate the regret of the other choices, difference between their payoff and the payoff of the decision with the highest return. Repeat. Step 2, repeat step 1 for each state. Then step 3, For each decision, you have to identify the maximum required, and step 4, select the project with the lowest maximum required. Okay. Now, advantages of this. The actual payoff is very close to what actually would have occurred if the best decision has been made, no matter whatever the state is. Next, your opportunity loss contains more problem information leading to more informed decision. So rather than choosing the best and the worst, this is like in between, you can say. Okay, compared to the other two, it's an in between. And here also you don't have to assign any probabilities to the outcomes. Disadvantages of this decision, on the other hand, is challenging to understand this model because you have to draw a table and all. And maximin, okay, as for maximin, it may lead to same for the previous, where for maximin we had it is excessive caution. This one is also like that, but this is not at an extreme level like maximin. Now, expected value. Expected value is your average outcome of your decision if you have repeated it many times. Remember, expected value you can't get for a decision which you have taken only once. It has to be repeated. It's like rolling a dice 100 times, 200 times. What is the expected value of throwing a dice 200 times? Like that. Now, expected value, this is how you calculate. You take the mean of the possible outcomes. I'm sure you know how to calculate the mean, right? That's your maths. So now, this sum, okay, this denotes the sum. So it's the sum of the possible outcome, that is xi, we multiply it with the probability of occurring, that is pi. So we multiply the probability of an outcome happening with the outcome and take the sum of all of that. That is the meaning of expected value. The decision rule is to select the course of action that gives you the highest expected value or the lowest expected loss if it's a loss. Okay. Advantages of this is it reduces the information to one number. Just choose one number which is the highest for each scenario. Second advantage, easily understood. Okay. Averages are easily understood by any stakeholder. Next, assigning probabilities, it converts, and see, by giving probability, it converts an uncertainty into a risk problem. As I told you earlier, risk is a known, uncertainties are not known. Disadvantages, and also it takes account of all the expected variability of all outcomes. Disadvantages on the other side is it's challenging to estimate. Okay, the probabilities that you give, they are estimates and it's challenging to get the estimates right. Average may not correspond to any of the possible outcomes and it's unsuitable for one-off decisions. It has to be repeated. Okay, and the average does not indicate the spread of the possible results. Again, it ignores the risks. Now, note that there is no one way, one right way to make a decision when you're facing uncertainty. It is just a way, but not the right way. In practice, business has to judge. They have to use their own judgment. Okay. So they must judge their objectives as well as risk appetite. For example, for large pharmaceutical company, they have to tolerate risk very well and understand that many projects for pharmaceutical especially do not succeed. So expected value here might be appropriate. If you are a small owner managed business, owners face a large risk. Okay. So here the best criteria would be maximin. Maximin is for risk averse. Try to avoid risk. If you are a business who is only interested in making significant return, you have to go for a maxi-max. Optimist, risk seeker, you seek risk for high return. Now, for investment manager, the minimax regret method might be appropriate. If you are an investment manager, you will go by that table, which gives the lowest opportunity cost. Because investors would want to expect them to predict all the uncertain external events and affect the value of the investments, even though they cannot. So let us go through example 1. Remember, decision-making computations are not expected for APM. Only Learning the analysis will reinforce your understanding of this decision making model. Okay, so here you can see there are three weathers: cold, warm, hot, and you are given three orders: small, medium, large. It's for an ice cream seller. Okay, and you have been given different. Now, under the three method, maximin, maximax, maximin, and minimax regret, you have to calculate. Okay, so the highest payoff for each order size is most appropriate for the weather. To get the highest payoff, you have to see the weather. Otherwise, profits are lost. Either ice creams are unsold or lost potential sales. Now, so we are going to calculate under the three method. First, maximin, highest payoff. If you see, under each small, medium, and large. So let us quickly do that. So, according to maximin, okay, the medium order has the highest of the lowest payoff. Okay, let us go back. You see here. Okay, so for medium, the lowest payoff, if you see, it's 200, right? This is for the medium. So if you place a medium order, that's what they have telling. The highest of the lowest payoff is 200 compared with 150 and 100 for small and large orders. See, we have to take the low. See, this is maxi min. Okay, I'm sorry, it's not maxi max, it's maxi min. That's why I got confused. Okay, maxi min. If you are risk averse, you want to take the lowest. Okay, you are going to take the highest of the lowest payoff. So if you see the lowest payoff under small, if you compare the small, the lowest is the lowest payoff is this 150. If you take the medium, the lowest payoff is 200, and if you take the large, the lowest payoff is 100. And if you compare the three of the lowest payoff, that is, we are assuming in the worst case scenario, we are going to take the highest payoff because it's maxi min. Min means we are taking the lowest payoff. Lowest, sorry, not lowest payoff, but the worst case scenario we are assuming. We are being pessimistic. We'll always assume that we are going to get the lowest. And once we get the lowest under the three different scenarios, out of the three lowest, we are going to choose the highest. You understand? So for small, the lowest is 150 payoff. For medium, the lowest payoff is 200 out of the three. And for large, the lowest payoff is 100. Now, out of those three highlighted figures, I'm going to take the highest. That's how maximin works. So highest is 200, which is under the daily. Sorry, which is for the medium size. Okay, that's what they have told here. That's 200. Next, maxi max. We are going to go for the max, assuming the best case scenario. So if you go here, you see the highest is, in this case, 750 is the highest. If you compare for all, the 750 is the highest. So 750 will be the answer using maxi max. Okay, for the large order, it has the highest payoff. If you compare it with your medium and small size, which is 250 and 500, so 750. Okay, in this case, it's 200. In this case, it's 750. That's how maxi max and maxi min works. Now, mini max regret. Okay, so for this, there's a table that we have to draw up like this. Okay, so as you can see, the optimal decision, cold weather is a small order. Now we'll see the best possible outcome in the three weathers: small, medium, and large. Okay, so the best possible outcome, we have to compare with the best possible outcome. Okay, so the best possible outcome for small is 250. That's in the cold weather. And for medium, the best is in the warm weather, that's 500. And for large, the best is 750, that is in the hot weather. So 250, 500 and 750. For the three weathers, these are the best. Okay. Now, here if you see, it has been 0. You see here it is 0. Why? Because this best is when this 250 is for this one. That's why here it is 0. Because 250 minus 250 is 0. Here it will be 0. Because here the best is when you're warm in middle, and here also it is 0. You see diagonally it's 0. It will work like this only. You have to find the difference. That's why regulate is 0 in this case. Now you have to find the difference. Okay. So in this case, if it's small and if it's warm, let's go back. It's 200. You see, it's 200 and 150 for warm and hot. 200 and 150. So 200 and 150. So if you see here, 200 you have to deduct from the best possible outcome. That's 500. That's how for small you get 300. And this is 150. So from 750 you have to minus 150, and that's how you get 600. That's for small. And you have to do for the others also like that. You have to deduct, and then you will get your regret. Okay, let me show you for others also. So for here, 200. You'll be having 200, 0 and 3. So 200 and 300 you have to deduct from cold and hot. So 200 from 250 if you minus is 50, and 300 from 750 is 450 for medium. Now let us go to large. Large you have to minus 100 and 300. So 100 if you deduct from 250 is 150, and 300 if you 300 if you deduct from 500 is 200. Okay. And the max regret. Then there is this column known as max regret. So maximum, this is maximum. That's how we put this as maximum. And out of this 450, this is maximum. And here the maximum is 200. And out of this 3, you have to go with the lowest maximum regret. Lowest. So lowest is 200 when you're placing a large order. Okay. Minimax. So now, if you see the optimal decision, see the optimal decision for the cold weather, if you see, is a small order, which is yielding 250. Looking at the table, so 250. And for medium, it's warm, and for large, it's hot weather. So you have to look at the optimal decision for each weather. For cold weather, it is which order? Small, medium, or large? It is a small order. And for warm, it is medium, and for hot, it's a large order. Okay. So this is how you work. Now we are moving to activity 2. So activity 2, we have the demands given and daily requirements given. You have to state the order quantity the greengrocer should sell it if she uses maximax, maximin, minimax expected values. Everything is given. Okay, for expected values, probabilities are given here. Okay, probability of 20% medium, probability of 40% high. Okay, so low probability is 20, medium probability is 20, and high probability is 40. So medium and high are having a probability of 40%, and low it is 20%. Now, so using this table, you don't have to read much. Using this table itself, you can find out. Let us find maximax. Maximax means the max. So the max in this case is this 55. Is it so? Let us see. Okay, so that is at 60. Yes, 60 kilometer high. So a maximist decision would choose to order 60 kilo. They will choose this because it is giving them the highest potential contribution. This is giving them 55. Now, maximin, in the worst case scenario, the highest this thing. So for maximin, okay, see for 20 kilo, it's 20, all are 20. You can't differentiate. So it's 20 here. And at 40, the lowest is 0. This is the minimum. And at 60, the lowest is this, minus 20. And if you see this one, the maximum is this 20. Okay, the maximum is this 20. This is the max. So they would order this because this is giving them the highest minimum profit, but at the highest. Now, minimax. So for minimax, the best is at the low, the best is 20, medium 40, and high is 55. Okay, 20, 40, 55 from the table. Now using the same, we are going to deduct. Here you see diagonally it is 0, and whatever the level of demand you have to deduct from the outcome at best, and you get this answer. And then you choose the maximum required. So at 20 it is 35, at 40 it is 20, and then it's 40. Out of this 3, they are going to choose, okay, the lowest minimax required. So the lowest is 20 in this case. So at 20 is at 40, so they would order 40, okay, as the maximum regret on any day would be $20. You see, now the expected value. So when you're calculating the expected value, remember in the first one, since all are 20, it is 20. But in size 40, you have to go back and check. You see in 40, the first one is 0, which is at 20%, and then both are 40. So since both are 40, you have to add 40 into 45% plus 40 into 45%. One is for high probability, the other one is medium. And then you get the expected value, first one 20, and at 40 you get 32, and for 60 you will be taking, you have minus 20, 30, and 55. So minus 20 into 20 plus 30 into 40 plus 55 into 40, because high and medium are 40%, and low is 20. So total is 30. That is the expected value. Okay, so if you see, the max is at 40 kg. Okay, because the expected value is highest, which is 32 at 40. So order size has to be 40 based on expected value. Now, decision tree. So here we have finished our decision based on maximax, maximin, minimax, and expected value. These are the 4 things we have studied. Now we will take decision based on the decision trees. It's like a tree that we draw, and from that tree different branches comes out, and we have to take an action. So here there are courses of action that are available and possible outcomes, and each of them are given probability, where we will weigh the risks and the rewards of each option that can yield. So this is beneficial if you are having a multi-stage decision problems. For example, one decision is dependent on another decision. So this problem will lay out all the options, and it's a complete analysis of all the possible consequences of each decision. It's like a framework to quantify the values of the outcomes and also the probabilities of achieving them. You can make the best decision based on the existing information and the best guesses. Example 2. Once again, you are not being told to draw a decision tree in your APM exam, but it is only for understanding purpose. We have put this here. You don't have to do any computations based on decision making. Okay. So the following, there's a decision tree. Okay. Of either you can introduce a new product or consolidate existing product. These are the 2 decisions. If you make a new product, okay, the cost of developing it thoroughly is 150, or rapidly is 80,000. And if you have consolidated, existing product can be straightened cost at 30,000 and the benefits at no cost. So from this understanding, we'll draw the decision tree. This is the decision tree that has been drawn up. Okay, as you can see, the two routes, one is new product, this one is consolidated. New product, thorough development, rapid development, and consolidated straightened product and reproduct. Okay, probabilities they have given good, poor, moderate, and in the last one for reproducts it's just good and poor. They have given you the percentage 0.4, 0.4, 0.2. That means 40%, 40%, and 20%. Okay, and they have given you the outcomes also. This is how a decision tree looks like. Now you are supposed to find out which one to go for. For that, you have to find the expected value. So for the new product, this is how you get the expected value, whether for rapid development or thorough development. If it's a thorough development, this is how you go about. Okay, you multiply 0.4 with this plus 0.4 into this 50 plus 0.2 into 2000 and get an answer for thorough development. Okay, you go by that branch. So for thorough development, this is the value 40, 420, 400 expected value using thorough. Now for rapid development, still we are under new product development only, this branch. Okay, we are still under new product development this here. So here we'll go by this branch 0.1 into 1 million plus 0.2 into 50,000 plus 0.7 into 2000, and then we'll end up getting this as a value, rapid development. So which one is higher? Of course the thorough development, not the rapid. Okay, so now if you go by the cost, they have already given you the cost, right? They have told that if you go for the thorough development, the cost is 150,000. So from 420 we are going to deduct 150,000 and this is the benefit. Whereas if you go for the rapid development, the cost is 80,000, which we are going to deduct from this amount and get this 31,400. So in this case, this wins. Thorough development wins. Okay, this is giving a high expected value. Coming to consolidate option. So for consolidate option, ripping there is no cost. So if you benefit of straightening, so if you go here, straightening, you have to see this branch. It is this 0.3 into 400 plus 0.4 into 200 plus 0.3 into 6 and get the value. And here also 0.6, this is for reproduct into 20,000 plus 0.4 into 2000 and get the two benefits. So here it is 129,800 and 12,800, the expected value. This 30,000 cost has been given already in the question. They have told the cost for straightening is 30,000, but there is no cost for reaping. That's why it is just 12,800 only expected value. In this case, this is more 99,800 compared to 12,800. But if you see the overall, this is bigger. 270,400 benefit is greater than 99,800. So it is better to go for a thorough development of a new product. Okay, so new product is worth more and should be developed thoroughly rather than rush to the market. This is your conclusion. This is how you have to come to the conclusion. And decision trees, mind you, is very easy if you know how to calculate expected value and then come to a decision based on that, based on the highest expected value. So how many options are there? 4 options. From new product, you can go for thorough development and rapid development, and from consolidated option, straightening and reaping. Out of the 4 options, the best one wins. That is new product and thorough development. So that's it for this lecture. From the syllabus parts, we are in section A once again and covering part G regarding risk and uncertainty in your planning, decision making and reporting of performance at all levels of an organization. And also we have included the impact of the risk appetite of stakeholders, discovers risk taking and risk neutral. Based on that, we have come to the 3 options, that is maximin, maximax and minimax track rate. So business can face risk and uncertainty in the environment. It's very common. They have to. Every business does this. You can't say there is any business in the world where there is no risk and uncertainty. It never exists. That's why there are various methods to deal with the uncertainty in your decision making. You can go for simulation and sensitivity analysis. Sensitivity analysis you don't have to do, but how do you do it? You just change the variables and see how sensitive the outcome is. For example, net present value calculation, which is dependent on discount rate, cost of capital, things like that. Now, for uncertainty, your decisions are affected by risk appetite. Then, decision rules depends on the risk appetite of the manager. And also, probabilities can be assigned to the outcomes. One is maxi-max. You're risk seeking. You want to take higher risk for higher return. Next is maximin and minimax. They are risk averse. For minimax, you have to draw the table of the opportunity that is lost. Then expected value. Then we go to the decision tree where all the courses of action has been represented and we choose the best outcome that is giving you the highest expected value. And it is useful for a multi-stage decision making, not just in one stage. And there are two technical articles you have to read, that is risk of uncertainty part 1, risk of uncertainty part 2 on your ACCA website. Thank you for watching and I shall see you in my lecture 3. And by the way, you can watch my lecture 1 now under my APM playlist as well as all the upcoming lectures which will be uploaded on my APM playlist. And meanwhile, if you want to take this PDF slides from me, all you need is you have to email me so that we can discuss on the payment details I can send you. Thank you for watching and do not forget to subscribe to my channel if you haven't subscribed, and please do watch my other subjects as well. It is not APM only. I have taught other subjects as well on my channel that they are AFM, AAA, SBL, SBR. Now tax is also there and now APM. Thank you.